how many people do both of us know who just couldn't take it anymore, and they became very emotional. Their life was flashing before their eyes. They thought they were going to be destitute. You conjure up all kinds of fears as downward momentum continues relentlessly day by day. And they finally can't take it. They sell, and they regret it for the rest of their lives. They think about it every day the market goes up after that. And so I would agree with you. An emotional response, just avoid it. It is usually catastrophic to long-term performance.
With markets across the board getting slammed relentlessly week after week for months now, investors everywhere are beginning to panic. With fears the Fed will raise rates, collapsing markets, combined with the ongoing fears of runaway inflation, we are in times of peak uncertainty and doubt. One notable investor who has been crushed over the last year is innovation-based investor Cathie Wood, with her firm's flagship fund down nearly 60% in under 12 months. In her latest interview, Cathie Wood explains the most catastrophic mistakes investors could make in a market like this and why 98% of participants will fail in the market. Make sure to stick around to the end of the video where I will cover some key on-chain Bitcoin data to see if it suggests the bottom of the markets is in. Also, only a small percentage of my viewers have subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
The most important thing is to get and stay on the right side of change. Now, what does that mean in terms of portfolio construction? Do you want to go 100% into a strategy like ours? Well, most, given the volatility, cannot do that. I might do that personally, and I have a majority of my financial wealth in our strategies. And that's because of the conviction I have in them on a 5-year basis. But just let's take the more risk-averse investor. If we're right, and there's going to be a lot of creative destruction out there, there are going to be a lot more IBMs and GEs. Again, they were never supposed to have failed as spectacularly as they have in terms of their promise. If we're right, then even the conservative investors need a hedge against that possibility. Our portfolios are a great hedge, and we have a white paper on our site about how adding our portfolio to traditional growth and value portfolios, 5 to 10%, I think, would have increased returns, and relative to just the plain vanilla value growth would have increased returns and lowered volatility, because the correlation of our returns, and you can see it in the last couple of years, the correlation of our returns to the traditional benchmarks has been very low. Last year it was negative, the year before it was positive, but over time, very low correlation of returns. And so we know that most of our clients that are advised by RIAs have exposure in, I think it's below 10%, and I think most below 5%. I certainly would be using this downdraft to increase that allocation, because if anything during the last year, and it is quite a year for me to be saying this, if anything, our conviction in how rapidly the world is going to change and how transformative these technologies will be as they converge and feed one another, our conviction in that outlook has increased dramatically. And I will harken back to 0809. How many people do both of us know who just couldn't take it anymore, and they became very emotional. Their life was flashing before their eyes. They thought they were going to be destitute. You conjure up all kinds of fears as downward momentum continues relentlessly day by day. And they finally can't take it. They sell, and they regret it for the rest of their lives. They think about it every day the market goes up after that. And so I would agree with you. An emotional response, just avoid it. It is usually catastrophic to long-term performance. What is additive and significantly so to performance is averaging down. It doesn't feel good maybe as you're doing it, but you would be shocked how little it takes if you're consistent and you just keep averaging down. The reason we concentrate our portfolios is because during risk-off periods, most investors and analysts diversify their portfolios and get closer to their benchmarks, the benchmarks against which they're measured. We do not have any one benchmark. That's not what we do. What we do is buy the stocks that they are selling, because very often in our portfolios, the stocks are either small positions in indexes or they're not in indexes. Our active share relative to NASDAQ or S&P is in the 3 to 6% range. So very few stocks in our portfolios are in the indexes. As investors are selling those shares, again, a decision just to get closer to their benchmark, we're buying them and concentrating our portfolios towards our highest conviction names. If you look at our performance, if you look at that strategy on a rolling 24-month basis, and to do that, we have 63 observations now, because we started the firm in 2014. 63 observations. Over a 24-month rolling basis, 91% of the time we have outperformed the broad-based averages. If you look at on a 3-year basis, so I guess we go down to, that would be 51 observations, I think, we have never underperform the market on a rolling 3-year point of view. What this means is that this rubber band has been stretched so tautly, so tightly, that we believe, and consider the source, but we truly believe, given the valuations in our portfolio, the growth in the portfolio, and the fact that we're probably looking at very choppy waters from a cyclical point of view, so that our secular growers are going to shine, we truly believe that rubber band will snap and the performance will rebound. I'm not going to say can't hold me to any particular speed, but we think the undervaluation in the portfolio right now has reached an extreme I've never experienced in my career. And I don't think we're missing anything. I really don't. Of course, when we go through a period like this, we examine all of our assumptions, and we can be very hard on ourselves, and that's a very healthy process. And I can tell you, and I'm talking about both macro and micro, I believe what I just said about our portfolios. They are ready like a coiled spring.
So there's Cathie Wood on the worst mistakes investors could be making in the current market. Having an emotional reaction, panicking now and selling after a 50% or more drawdown is clearly the wrong decision in the long run. However, as hard as it is to do, averaging down as prices drop and concentrating on your highest conviction picks, Cathie says is the winning strategy. Interestingly, despite being completely different in their style of investing, Cathie's advice mimics the famous quote of Warren Buffett, "Be greedy when others are fearful." Do you think Cathie is correct, or do you think there is more pain to come for risk-on assets? Let me know in the comments. Now, to cover some of the latest on-chain Bitcoin data, out from on-chain analyst Will Clement, we have some interesting data regarding Bitcoin whales. As you can see, Bitcoin whale holdings generally track the Bitcoin price. Since the end of September, whales have been selling holdings, yet we are seeing some tentative signs that they have begun adding to their balances again with the recent price weakness. As we have covered in the past, the supply side dynamics are so strong with Bitcoin, it won't take much to see a price snapback. This is a trend Bitcoin bulls will want to see continue. Anyway guys, hope you enjoyed today's video and that provided you with some value. I'll see you all in the next video, and as always, have a great day.